Good evening, ladies and gentlemen. Happy Friday, October 29th, 2021 to you all. Welcome to our regularly scheduled open forum Q&A session. Let's navigate Wall Street trick or treat for October 29th. It's great to see you all here. And as we always want to begin, we first want to discuss what is Power Options? Well, Power Options is a patented suite of search and analysis tools for self-directed options investors. Using our tools, you can search across the universe of options in over 23 of the most commonly used option strategies. You can set various stock and option criteria to identify only those trades that match your personal risk-reward tolerance in a given strategy. And of course, we offer quick links to help you further research and analyze the stocks or the options, compare different strategies, risk, parity trade, and more. We also offer a powerful set of portfolio tools to help you track and manage your positions, evaluate rollout opportunities, and more. We also offer a virtual library of archived webinars, not only to help you get more familiar with the tools in the site, but the various option strategies. Now, Ernie Renner created Power Options back in 1997, but everyone here on staff, myself included, uses these tools to trade our personal accounts, so we have many more years of combined trading experience. Now, our process and procedures for our Friday afternoon's presentation. When you logged on to the webinar, the GoToMeeting, GoToWebinar platform would have appeared on your screen. Inside that platform is a question pod. Just use that pod to send us a question at any time during the presentation. If you don't see the pod, you may be able to see it in the tray below by clicking that little flower icon, or if you see a small bar on the side with that orange arrow, click on that and it will expand open the window. Your questions could be about anything related to general options trading and investing. Your questions about general options strategy. What is the structure for a covered call? We're going to take a look at collar structures and collars for Pavel in just a moment. You may have questions about trade management, when to roll or exit a position, triggers for rolling and exiting a position. What are good ways to roll or adjust a position that is in trouble or to look for more profit? You may have questions about option specifics. What is implied volatility? What is gamma? What is theta? Or even the options basics. What is a bid-ask spread? What is in the money? What is out of the money? That is all fair game. Of course, if you have questions about the tools on Power Options or the concepts of the limited risk radioactive trading techniques, we're going to see a little bit on as well. You can ask those at any time. Our basic ground rules. Don't be shy. Please feel free to ask questions at any time during the presentation. Be patient. There may be one or two questions ahead of yours, but we will get through them all. We have one or two that came in via email. We're scheduled to be here from 4:30 p.m. to 5:30 p.m. Eastern Time, but if we have a high volume of questions, I'll be more than happy to stay online to make sure all questions are handled. We do encourage you to feel free to help us help others. If a discussion is going on, and I give my thoughts based on what I've done in my account or other discussions I've had from other customers, but you have a different way of analyzing a position, evaluating a rollout opportunity, or a criteria you like to use for a given strategy, send that to us in the discussion, and we'll share it with the rest of the audience. I may ask you for clarification on your question just to make sure I understand the topic completely, and I've looked at it thoroughly enough and I don't go off on a tangent describing something else. Most important, let's have fun. Let's get some good education under our belts before the start of the Halloween weekend here. Chuck says, kia ora from New Zealand. So hi, Chuck, how are you doing? Kia ora to you as well. I hope I pronounced that right. All right, now before we jump into one of our questions that came in via email, I just want to remind everyone of the recent content that was posted this week. We posted 2 webinars discussions the other day. Can I use the stock repair for a bought call option that is down? Some of you may have seen the stock repair in action in some of our presentations. We take a look at using that same stock repair structure if I bought a call, but it's now losing in price. Should I close a covered call just before expiration or potentially roll it out? That was a discussion. We had a few topics on married puts that was posted over the weekend. The question that came in last week were, what are the most conservative option strategies? And we had a question about, can a short strangle repair a stock that is down? and evaluating an out-of-the-money bear put debit spread inside of a married put. So all of these were actually pretty short, under 25 minutes. Most of them were under 17 minutes, actually, or right around 18 minutes. So nice, digestible material for you, and we're going to have some more segments going today as well. This question, came in from Anthony. And Anthony says, is there a strategy to repair a covered call trade when the underlying stock suddenly gaps up? No, in a sense, nothing more than the obvious. There's no hidden secret, Anthony. We would have told everyone if there was a hidden secret to doing this. We've had multiple discussions over the past few weeks and some big ones recently. Let me just go to ITM. I think it is Covered Call. Hopefully that'll give us what we want. Caps lock off. There you go. Rolling a deep in the money covered call. We're in a CCXI covered call. That was from 2 weeks ago. The stock jumped up high in price, and we evaluated what rollout opportunities are available on the position, what you might consider. Tips on rolling a deep in the money covered call, liquidating a deep in the money covered call, and rolling a deep in the money covered call at expiration. That was from 10 months ago. So these things happen. There's no one secret. I wanted to show you this first, so there's other ones you can look at. This might be one you could consider from 2 weeks ago. What was the time on that? It's only 8 minutes long. So you might want to consider watching that one while you're waiting for some of the archives to come up. Why do these questions appear? Well, naturally, these questions appear because these things happen. Stocks exceed expectations with certain news. CCXI was the big one from 2 weeks ago we saw. And we take a look at the chart. I don't know if it's come back down since then. Nope, still up there. So we may have bought stock at 16 or 17, sold an 18 strike call, and it gapped up to 40. This wasn't earnings related. And this was actually due to an FDA approval that was passed for the company, and yeah, pretty much doubled in price overnight. So now I'm holding this 17.5 strike call, let's say, the stock's trading at 40. It's going to cost me $23, $24 to buy to close that call. Now I can roll up and maybe make a higher return, 2 or 3% more, the same time value that's available if I opened a new covered call right now. But do I want to do that? Can I buy a call now at this higher strike? No, that doesn't cancel the obligation that I have to deliver my shares of stock at 17.5. That's still going to be called away. That doesn't change it. You committed to the covered call for the return that you wanted on the position if you were assigned. And when these gaps happen, unfortunately, you can roll the position, but it's going to cost a debit. And what is the debit really going to do? It's going to increase the cost basis on the position. So, here, let's say that we did buy the stock at 16 and we sold the 17.5 call at some point, and we got maybe 50 cents for it. So we've got a $15.50 cost basis. And so naturally, if we get assigned at $17.50, we're making a $2 profit. That's going to be pretty strong. Now the stock goes up to here. Where are we? Well, we're right at 40. Let's just call it 40 after the gap. What do I know about this 17.5 call? It's at least going to be $22.50 of intrinsic value, and it might be even higher because if we still have time left, that might have been 23, 24. So I got 50 cents. I pay 24 to buy it back, and now I sell a 40 call. Well, my cost basis is now what? $39.50, and I'm selling a 40 call for maybe $1 or $2. Still a good return. But you miss this. Okay, in order to stay in the position, you have to do this. I can't just do a spread right now. I can't just buy a call after the fact to create a spread that leaves the upside open because the move has already happened. Let's take a look at today's example. Many of you saw this in the news. I had a couple phone calls about it from Power Options customers, similar to what you are asking, Anthony. We'll take LCID, Lucid. And this was non-earnings related either. They just announced that they're delivering their first electrical cars this weekend. I don't know how many they're delivering or what they were supposed to deliver. If they're just delivering 1 or 2, I'm not sure. But of course, overnight they go up from $26, $27 up to about 40, and then go up to 42 and come back down a little bit to about 37. Yeah, right at 37 right now. So 9-10 point movement in the past 2 days. And if you were in the position at 24, let's say, and sold the 25 call, how much is it going to cost you to buy it back? Is it worth it to do that? Let's take a look. We're going to go back to power options. We're going to go into the portfolio. There's our FCX example. If we needed to reference the profit and loss chart again for Pavel, that's why that's there. And LCID. Let's say on October 22nd, we just looked at the chart. The stock was trading at 24.11. We buy 100 shares. And at that time, the just out of the money, 1 week out, October 25 call was for 53 cents. Sort of where I got that 50-cent number for the CCIX position, although I think it was much higher. It was around a $2 because of the higher volatility. In any case, where are we now? The stock's up 53% to 37, where we got in at 24. Call premium is right at intrinsic value, isn't it? We sold at 25, the stock's at 37. It's costing me about $12 to buy it back. It is right at intrinsic value. And today, I'm sorry, this was a 7-day trade. If I get assigned, I'll make a 6% return. I think I'm going to be happy with that for 7 days, believe me. And I understand. But if I'm still bullish on the stock, I want to keep trading it. What can I do? Well, unfortunately, Anthony, the only trick now is to roll the call. And it's going to cost us $12. But we can use the position action and the position analysis. Here's my covered call position. We know where we are right now. We're roughly at about a 6.1% return after 7 days. Yes, this would have been assigned because we didn't close it. We're just using this as an example. But I see that I have rollout opportunities here. So these are the in the money ones. Why are we showing options that are still in the money to roll to now that the stock's up to 37? And it's because we're showing you opportunities that would increase your return. If I just roll out for the next 7 days to November 5th, and I go up to the 31 strike call, I'm taking my current 6% potential return if assigned at 25 today, and increasing it for the next 7 days up to 7.9%. So I'm gaining a positive 1.9% return, staying in the money in this example if the stock stays above 31. Now, the ones here that aren't shaded, these are out of the money. What do we notice the difference between the two? Since these are in the money, this here is the adjusted net credit. This means the debit. We took in 53 cents. I'm paying $12 roughly to buy it back. Staying in the money, I get another $6, $5. I'm only increasing my cost by $6 or so. We go out of the money to the higher strikes. We're still getting great premium, $3, $2, but now our additional cost is going up to $8.61. And what does that mean? Well, my original cost was $23.60, that $24.11 minus the 50 cents. Now I'm adding $8, so we're putting our cost basis up to about $31.60, $31.70 in this case. I still get a higher return if the stock continues to move up. That is reasonable. If I'm making 6% now, and I think the stock's going to continue up above 40, even though I'm paying the extra cost in, I could make 19.2% if I'm assigned at 39. I think that's a fair trade-off. It's speculative, very. It's a little bit risky. Why am I saying it's risky? This move suddenly happened up to 37. Remember, we had a cost basis of, let's call it $23.60. We're paying $12 back in, but getting another $3 back, so we're increasing it by $8.60. So we're at, $32.40, $32.50 roughly of a new cost basis. If something happens with Lucid and its delivery over the weekend, it's saying it's expecting to deliver its first cars, but if something happens with the delivery, or they're expected to deliver another, I don't know the numbers, let's just say 400 cars the next weekend, but they only deliver 100, this might fall back potentially down to 32, 30, 29. Now we're at a loss because we have such a higher cost basis. Can you always roll for a credit in these situations? It's obviously much harder. But if you go further out in time, this was just a weekly trade, remember, Anthony? If I go further out in time, sorry for the scrolling, I start to see ones that appear at a credit, November 26th. It's right at 11.83. So I took in 50 cents, pay 11.98 or 12 back, and then get 11.83 in premium. But for 28 days, I'm increasing my return from 6% up to 9.6%. 3.6% for an additional 21 days, 28 days, that might be okay. Remember, we're at 6% now, so that's a good increase. Here, we're still at a debit, but we're still seeing an increase in return. So, all these rollout opportunities here, but to get to where you want to see a credit on a regular basis, you're not going to see one out of the money. To see more credits on a regular basis in the money, you're probably going out to January, which is 84 days away. In other words, we're still seeing small debits here, but we're increasing the return. But the debit to roll is not that bad because of the extra premium, but we're 84 days out in time. You committed to the covered call. It has a capped gain. Once the giant move happens, there is no secret. There is no combination of spread positions that you can do to get back to break even. Your decision now, is it better not to add to the cost basis on this particular stock? Sorry, folks. Get assigned. Just let it be assigned, earn the 6% return, and maybe buy back into it, which is almost the same way of rolling the position. What do I mean? If I let this position be assigned at 25, right, we get $2,500 back. We have our 6% profit on the position. Now I buy shares at 37. So I'm adding $12. Let's say on Monday it stays at 37. I buy at 37 and sell the 38 call. Well, I'm increasing my cost basis by $12 and then getting the premium of that 38 call, another $2 or $3. It's almost the same as rolling right now, paying the $12 to buy to close the call, so deep in the money it's at intrinsic value, and then selling the 38 call. It's pretty much the same. Right? There's no difference really between liquidating this position and buying it back on Monday, or allowing it to be assigned and buying it back on Monday, or buying the call back right now and rolling to a new position. Of course, this is also because we are at expiration in that case, Anthony. Now, I said you committed to the covered call, and the stock exceeded your expectations, and now you're deep in the money. I said there's not much you can do about it now. You could consider rolling the call or just taking assignment. Could I have done anything before? Yes, but I don't know if it matches your goals. Meaning what? Oh, sorry, let me go back here. If I went back to October 22nd for LCID, we sold the 25 call. Let's go back a little bit in history. And the closing price you saw I entered was $24.11 at the time. And we sold the, sold the 29 weekly 25 call. That's where I got the 53.54 cents from. Let's take half of that. Let's take a third of that. The 28 call here is at 18 cents. If I had bought at the same time the 28 call and sold the 25 call, which would have been a bear call credit spread, but with owning the stock, it's just a covered call with an extra long call open that leaves the upside open in case the stock exceeds your expectations. It's sort of a bear call credit spread on top of a stock position. So we bought the stock, sold the 25 call, which obligates us, but bought the 28 put. So now we're here at a profit of $1,000 instead of what we saw in the static covered call position of 6% return. Okay? It leaves the upside open. But what did I do? I gave up some of the premium, about a third of the premium here, by buying this October 28 call at 18 cents. But it does leave the upside open. I still take in, what is that, 35 cents of positive premium to lower the cost basis. And in here, I'm still looking at a decent return between 25 and 28. But again, when it exceeds expectations, you have the upside open. But you would have had to have done that before. When you enter the trade, you would have had to have done that, not after the fact. So I just wanted to review that, and we'll post this section for that discussion as well. I just want to remind you, Anthony, the one I really like for the discussion is this one here, that 8-minute one, rolling a deep in the money covered call, the CCXI covered call that had that big jump. But there's other ones here. Is it worth it to roll an in the money covered call? Rolling deep in the money covered calls. But I really like this new one, the CCXI one. And I like this discussion we just had as well. Didn't review the rollouts in depth as much, Anthony, but that's sort of the concept there. Once it's happened, there's no magic trick. If I had a magic trick, some magic in the money covered call repair that didn't get too crazy with trying to enter a 3 or 4 leg 2-week out position to, cover the obligation of X and Y and still give you a little bit more profit, we would tell you. The most common approach now is just decide to let it get assigned. Buy it back and pay the extra cost. Realize you're increasing your cost basis and that might lead to larger risks if the stock pulls back. Or liquidating the position and taking a profit, again, most likely just allow it to be assigned.